Nvidia has already delivered one of the largest stock market rallies in recent history. So, at today's price, the obvious question is, are investors too late? Based on Nvidia's historical valuation cycles, revenue growth, and price momentum, I believe the answer may be no. One indicator that previously appeared before rallies of 350, 570, 460, and even 1,800% is now producing another bullish signal. At the same time, Nvidia's valuation indicators suggest the stock has not yet experienced the kind of prolonged overheating that historically appeared near major market tops. And when we combine these signals with Nvidia's projected revenue growth, my regression models point to a potential price range of $400 to $500 by April 2028. In this video, I will break down the historical evidence behind that target, starting with Nvidia's Revenue Momentum Oscillator. The Revenue Momentum Oscillator, or RMO, measures whether Nvidia's stock price is running ahead of or falling behind the company's underlying revenue trend. When the indicator moves deep into the green zone, it suggests that the price has fallen significantly behind revenue. Since 2002, Nvidia's RMO has entered this deeply undervalued region 6 major times. What happened when the indicator began recovering? The first signal appeared around 2002 and 2003. After Nvidia's emerged from the green zone, the stock entered a 4-year bull run and gained approximately 350%. The next two signals appeared near the end of 2009 and again near the end of 2010. Those signals resulted in smaller but still meaningful rallies of approximately 70% each. Then came the 2012 to 2013 signal. After the RMO recovered from the green zone, Nvidia began a 5-year bull market that produced a return of approximately 1,800%. The next two signals were also meaningful. One was followed by a roughly 570% gain over 2 years, while the other was followed by approximately 460% over another 2-year period. The size and duration of these rallies were different, but the broader pattern was remarkably consistent. When Nvidia price fell behind its revenue trend and the RMO eventually recovered, the stock entered a new uptrend. Now, look at the current setup. The RMO has remained in the green zone since the beginning of 2025, but it is now beginning to move out of that region. Historically, this transition has not marked the end of a rally. It has often marked the beginning. That does not guarantee Nvidia will repeat one of its previous 400 or 1000% moves, but it suggests that the current cycle may still be in its earlier stages rather than approaching its conclusion. The second indicator is Nvidia's price to sales ratio compared with its own 2-year average. When this indicator falls below -1 standard deviation, it moves into the green zone. Historically, each time the indicator entered this zone and then crossed back above it, it was a strong indication that Nvidia's major bottom was already behind it. That happened during the summer of 2025. The indicator recovered above -1, suggesting that the previous decline had likely established an important bottom. However, Nvidia's valuation has recently weakened again. The indicator has dropped back below -1 and currently sits near -1.5 standard deviations. At first glance, that may appear bearish. But the more important question is not whether Nvidia can experience another pullback. It clearly can. The more important question is whether Nvidia is forming a major long-term top. To answer that, we need to study what previous tops look like. Historically, Nvidia major tops did not occur while its P to S ratio was sitting below its 2 years average. Major tops occurred after the indicator had moved into the overheated region and remained elevated for an extended period of time. That prolonged overheating showed that investors were paying increasingly aggressive valuation for Nvidia's revenue. We have not seen that type of setup since Nvidia's previous major top in late 2024. Since then, the indicator has either remained in the green zone or recovered only briefly before falling back. In other words, Nvidia has not yet gone through the prolonged period of valuation expansion that historically preceded its most important tops. That suggests the larger cycle may still have room to continue. The stock can pull back along the way, but based on this indicator, those pullbacks may represent opportunities to gradually dollar cost average rather than evidence that the entire bull market is over. Now, let's connect Nvidia's valuation signals with its actual business growth. This chart compares Nvidia's stock price with the company's quarterly revenue. Since approximately 2017, the relationship between the two has been extremely strong. As revenue increased, price generally followed. Nvidia currently generates around $80 billion in quarterly revenue. Based on analyst estimates, quarterly revenue could reach approximately $160 billion by the middle of 2028. That would represent a doubling of revenue within only a few years. But does that mean Nvidia's stock price must also double? Not necessarily. Revenue growth is only one part of the question. Valuation, profit margins, operating expenses, and investor expectations will also determine the final outcome. That is why I built linear regression models comparing Nvidia's stock price with both revenue and earning per share. Based on those relationships, the models estimate a potential Nvidia price range of approximately $400 to $500 by the end of April 2028. This is not a precise prediction. Models cannot anticipate every market correction, economic shock, competitive threat, or change in investor sentiment. But this price range is directionally consistent with the other indicators we have examined. The RMO suggests Nvidia may be emerging from a period in which price lagged revenue. The P to S indicator suggests the stock has not yet experienced the prolonged overheating that normally associated with a major top. And Nvidia's projected revenue and earnings growth support the possibility of significantly higher prices if the company continues executing. There is one final piece of the analysis that investors should monitor closely. Nvidia's stock price has also shown a very strong historical relationship with operating income and free cash flow. Revenue growth attracts attention, but revenue alone does not create shareholder value. Nvidia must convert that revenue into profit and cash. As the company invests heavily in research, new chips, network infrastructure, data center system, and future product platform, its expenditure will also rise. Those investments may be necessary to protect Nvidia's competitive position, But if expenses begin growing substantially faster than revenue, operating income and free cash flow could weaken. That would create a disconnect between Nvidia's revenue growth and the financial metrics that have historically supported its stock price. Therefore, I would not monitor revenue in isolation. I would watch quarterly revenue, operating income, free cash flow, and the relationship between all three. As long as operating income and free cash flow continue expanding alongside revenue, Nvidia's long term price trend should remain supported. But if revenue continues rising while free cash flow begins deteriorating, that would be an important warning signal. So, is Nvidia approaching a major top? Based on these indicators, I do not believe we currently have enough evidence to make that conclusion. The revenue momentum oscillator is beginning to recover from a deeply green region, a setup that historically appeared near the beginning of major rallies. The P to S ratio versus its 2-year average remains depressed and has not yet produced the prolonged overheating that normally appeared before Nvidia's major top. Revenue is projected to potentially double by 2028, and my revenue and EPS regression models estimate a possible price range of $400 to $500 by April 2028. The primary risk is whether Nvidia can convert that revenue growth into sustained operating income and free cash flow. As long as those financial metrics remain aligned, the historical evidence suggests the larger move may still be ahead of us. That does not mean Nvidia will move upward in a straight line. Volatility and sharp corrections are normal, especially for a stock that has already generated enormous return. But rather than viewing every pullback as the end of Nvidia's cycle, the data suggests that pullbacks may continue to offer long-term investors opportunities to build their positions gradually. This analysis is based on historical data and a statistical relationship, not a guarantee of future performance. If you found this analysis useful, subscribe to Fundamental Signals for more data-driven stock analysis, historical backtesting, and valuation signals. Thank you.